Bank of England on the Bank of England February 2022 Monetary Policy Report. Very pleased to be joined by four witnesses this morning who will ask to briefly introduce themselves, starting, Andrew, with yourself, please.
Andrew Bailey, Governor of the Bank of England.
Thank you very much. Jonathan?
Jonathan Haskel, Economics Professor at Imperial College and an external member of the MPC. Thank you.
Thank you, Jonathan. Silvana?
Silvana Tenreyro, external member of the MPC.
Thank you very much. And Ben, please.
Ben Broadbent, Deputy Governor for Monetary Policy.
Great, thank you. Well, welcome and thank you for coming in to see us this morning. Governor, could I start with you? Transitory is a word that we've discussed many times, including on this committee, in relation to inflation. And in the latest report, the word doesn't appear, whereas it did appear in previous reports. In fact, in November 2021, quote, the committee's central expectation continued to be that elevated global cost pressures would prove transitory. Why has the word disappeared, and what do we interpret from that?
Well, first thing I would say about that is probably, and not just in this country, a slight concern, certainly speaking personally, that the word was becoming overused. But I think in substance, I would say that while it's important, I think, looking at the profile of inflation that we had in the February report, that actually it does return to target, well, actually technically returns to target during the third year.
Given that it peaks at 7.25 in April and
yes.
It's expected to go down, then it's still transitory, isn't it?
Well, it is, because obviously the
yeah.
goal of monetary policy is to bring inflation back to target. So in that sense, yes, it is transitory.
Why not the word in the report?
Well, I must say personally, I think it was becoming a slightly overused and in some circles over-abused term, and I think it was important to get more onto what I call the substance of the profile of inflation. The other thing I would say is that we've also got two-sided risks on this forecast, and for me certainly I think the risks are very important. So one risk, and I'm sure we'll come on to discuss this during the hearing, is that there is a risk that it will be there will be higher inflation for longer. The other side of the risk is that it will come down faster, which we demonstrated in the alternative scenario. But I can only speak personally on this. I think colleagues may want to come in about this use of the word, but I was certainly concerned that it was becoming somewhat overused as a word. And I say not just in the UK, actually. I mean, this was going on in some other places and becoming slightly overabused, I think. So we wanted, certainly speaking for myself, I wanted to get more of the focus on the substance of the of the profile.
Some might imagine that it reflects the fact that previous forecasts have proved to be inaccurate in terms of where inflation is heading, particularly the more recent forecasts actually compared to the ones further out. And therefore the bank has finally decided to kind of hedge its bets because you're less certain about the transitory.
Well, I mean, there is a very high level of uncertainty. I will be very clear on that, and be happy to talk about that because we have been hit by shocks, particularly external shocks, that have caused obviously inflation to be higher and to go on for longer than we did expect it to be going back in time. That's true. Sorry, Ben, I cut you off.
Sorry, before I come to you, I do want to come to you, Ben, actually, because of the four of our witnesses this morning, you're the one that wanted to go further on the interest rate rise to 0.75%. Is that right?
No, that was...
that's Jonathan.
Sorry, Jonathan, I'm so sorry. I'm so sorry. A vile accusation. I'm so sorry.
That's all right.
Depending on which way you look at it.
No, I'm very
in which case, let me then
with
switch to Jonathan. Yes, Jonathan. Right. So you wanted to go further, which rather implies that you're more concerned, perhaps, about where inflation is going than some of the others that voted a different way, the governor and the other members of this panel. Can you just talk us through, therefore, your thinking there? Are you thinking it will be less transitory than some are imagining, or even if than this report is perhaps suggesting?
No, thanks very much, Chair. On the transitory issue, I gave a speech in Glasgow recently, and I was asked whether I was on team permanent or team transitory, and I replied that I was on team vigilant. So I think, the sort of labels, as the governor was just saying, of transitory and permanent are just kind of not right, and they pigeonhole people too much. So I think that on that issue, I don't think we need to sort of worry so much about that language. As far as I was concerned, I put a little bit more emphasis in a world which, as Andrew has just said, is extraordinarily uncertain, on some of the forward-looking indicators that we had in front of us. So, for example, you'll know that we run, in conjunction with the University of Nottingham, the Decision Makers Panel, where we ask firms about their intended price increases. That normally runs at a couple of %. That had gone up to about 4%. The bank, that's one forward-looking indicator. The bank also has a very good agent survey of wage settlements, which we run. Again, that normally runs at sort of 2-3%. That had gone up to 4, a little bit higher than 4%. So that was sort of second forward-looking indicator. And the third forward-looking indicator that I thought we should take account of was that the contribution to inflation of service sector inflation was going to rise according to our short-term inflation forecast. So those three forward indicators I gave a little bit more emphasis on, and I thought therefore we should move a little bit sooner. But I have to stress, it's a very uncertain situation and it's a very, very finely balanced decision. Does that help answer?
That does. Now, in that speech, you also focused on the tight labour market in particular. And is part of your thinking here that the upward pressures in the labour market might start to get into some, I know we always talk about this wage price inflation, etc., but that kind of dynamic, is that something that you're feeling might be more of a problem compared to some of the other members of the MPC?
Well, that's why I was referring earlier on, if I may, to the notion about being vigilant, because I think that's the important thing, that what we don't want is we don't want this blip of high gas prices in particular and possibly high oil prices possibly coming down the track. We don't want that blip to turn into a sort of permanent, embedded form of inflation. If you forgive me using kind of sporting analogy, if everybody's at a cricket match and everybody stands up, nobody gets a better view. So what we don't want is we don't want everybody to be sort of chasing each other. And we don't want all of that, as I say, to be kind of embedded. So I was nervous about that. I was a little bit nervous about that. The speech that I gave that you kindly referred to was in the context of November. And I will just say that was in the context where it was extraordinarily difficult to make a judgment on what the state of the labour market was. Unemployment, which is normally a pretty reliable indicator of the pressures in the labour market, was about 4.5%, if I remember correctly. But the number of people on the furlough scheme, even in the week preceding the end of the furlough scheme, was 1 million people. I mean, that is a lot of people. And it was very uncertain, I think, about what the pressures in the labour market were at that time.
As things panned out, the pressures, if any, a lot of these people that were expected perhaps to be made redundant weren't, and actually went into the labour force. And
exactly so. But I think, and it's easy to second guess all of those. Maybe we'll get into this later on. It's easy to look back and say, well, my goodness me, all those furloughed people, they were reabsorbed in the labour market. So what were you thinking? But we didn't know that at the time.
Would it be fair to say, to sort of link your view of where interest rates should have gone to this issue of the labour market, that you felt we should have had a higher rate move upwards in interest rates, because that would have helped anchor inflationary expectations, and the effect there would have been to have dampened down perhaps some of that, those wage growth expectations and bargaining and so on, and helped in that respect? Was that sort of central to where
indeed,
you were on the thinking?
That nicely put. So I'd agree with that, but also I think we've been surprised by how tight the labour market has been relative to that very uncertain situation, as I say, around the time of, that I made the speech. So it's been much tighter than perhaps at least I was expecting, I should say.
Can I say
Yes,
one thing
Silvana
about
and
that?
then Andrew. Yes,
So
please.
normally in economics or in the jargon, we talk about transitory as shocks that dissipate before monetary policy can have its peak impact. In that sense, we were talking about transitory. The shocks that we are facing are still transitory in the sense that they are not permanent, but they are slightly more persistent, and the monetary policy can do something about that.
That time horizon on the monetary policy being affected being 18 months to 2 years, would that be your...
So there's a range of estimates in the literature. The peak impact of monetary policy, the latest estimates for the latest period would be 12 to 18 months. That's the peak impact. And so that's the reference point for transitory or not. But in the English sense of the word transitory, this is still a transitory shock in the sense that it's not permanent.
Okay, understood. Thank you, Silvana. Andrew.
I just wanted to draw a point on point Jonathan was making about the sort of distinction between sort of voting for 50 and voting for 25. And make the following point from my point of view. I think it's important not to put too much emphasis on, and Jonathan wasn't, by the way, on whether we took a different view on the level that we expected to get to, as opposed to the pace by which we get there. And I think there was certainly from my perspective, a genuine difference and a good difference, an exchange of views on whether it was sensible to move by 50 in one step now, which would give a strong signal, of course, a stronger signal, or to go in more graduated 25s, which allows you then to sort of, see what happens, as it were, before you take the next decision. And that's that was a genuine, and to my mind, difference of view within the committee. But I just want to emphasise that point. It doesn't, of course, necessarily mean that we take a different view on where we get to eventually.
Yes, thank you.
Agreed.
Ben, did you want to add anything to this? Sorry, I cut you off earlier.
No, that's fine. I was going to say more or less what
Yeah.
Silvana said. I mean, one of the problems with the word transitory was a lot of different interpretations developing what that meant. The fact that we've had these upside, even further increases in price of gas and other tradable goods doesn't mean somehow that suddenly nothing's transitory anymore. Because the horizon was, to me, as Silvana pointed out, was all what we meant by that word was a much longer horizon. The relevant thing is, does the underlying shock last long enough for you to have to address it with monetary policy? And traditionally, or the orthodox response, say, to a big jump in oil prices is, quote, to look through it, or at least to not to respond to it unless it gives rise to the sort of second round effects on domestic price and wage setting that Jonathan was talking about. And that's not because we can't do anything about the global supply of oil, which is obviously true. There are all sorts of things we can't do, anything that policy can't directly affect. It's simply because its influence on inflation doesn't last long enough to be worth doing something. So the price of oil jumps massively and we were to tighten monetary policy, then actually the direct effect on inflation is gone after a year, and policy wouldn't be able to do anything anyway. So all you do is depress the economy in response to a shock that disappears before policy takes effect, which would not be worth it. So that is the crucial thing. That's I'm just emphasising what Silvana said. That is the crucial bit of what we understood by the term transitory. Is it still there? Are these gas prices, rises in computer chips, all the things that have been happening through 2021, are they still going to be pushing up on inflation by the time a policy decision taken now really has an effect? That's the relevant question. Not have they gone on for 2-3 months longer than we expected 6 months ago, which is certainly true. And the geopolitical developments have caused even further increases in gas prices, as we know.
That's clear. That's helpful. But going back to the wage, and you touched on it there, the domestic price pressures, wage pressures, etc. Are you, as witnesses today, feeling comfortable with where we are on interest rates and monetary policy in terms of controlling those second round effects? Because whilst I take your point, Ben, about monetary policy being a sort of rather blunt instrument in the context of energy price movements, when it comes to the wage and labour market, however, it is about anchoring expectations of where inflation is going. And are you all feeling very comfortable on that point, or are you sitting there feeling, well, there's a lot of uncertainty around that, and this is a tiger that could escape and cause a major problem? How are you feeling?
So I can start on that. Because I want to make a point which I know goes back to these comments I've been widely reported on making. It's not just wage setting, it's also price setting. Because it's also company margin.
Although you've not stressed the price setting.
I was asked a particular question at that time, but I want to make clear that actually it is, of course, it's both. And there is very clearly an upside risk now, and the upside risk, as Ben was explaining, comes through from the second round effects. And it's quite understandable, of course, that the wage and price setting process will seek to correct for the very big external shock we've had and the very big shock we've had to national income, because this is a terms of trade shock. I mean, it's, if you like, it's a sort of effectively like a tax on the UK from outside. The problem is that if the whole process tries to do that and tries to offset the shock, then we get the second round effect setting, a real risk of the second round effect setting in, and we get domestically generated inflation. Now, we're not saying there'll be no pay increases. Of course not. That's not what we put in the NPR. And we drew on our agents' work, because our agents did a survey of firms' pay intentions start of this year. What the agents told us was that there was very clearly an uptrend in that, and that was, of course, reflecting the evolution of inflation. So we've been very clear that we've taken that into account. But
it's a very late. I know we touched on this point, I think, at the last session. This was spillover of the hot parts of the labour market into a more generalised situation. Is that still the very latest evidence that you're sensing from your agents?
Yes, I mean, I was doing a regional visit. I did a visit to Wiltshire last week, talking to firms, and it is the first, second, and third thing firms talk to you about, which is the labour market, and then how it spills over into wages and prices, and I'm not surprised about that. So the second round effects are for me a real concern. And I should say that, of course, if we get the second round effects, going back to the point Ben and Silvana made about the duration of those effects, of course we would need to react to that with higher interest rates. I mean, most likely that would be the consequence. And the consequence of that, I have to point out, and I know I'm unpopular for saying these things, is that it would, of course, slow activity in the economy, and it would increase unemployment. I mean, you've probably seen in the NPR, we've got a pickup of unemployment from a low level that we expected to get down to just under 4%, that it picks up to about 5% in the projection we've got. In a world where we had to do more on monetary policy, the most likely outcome would be it would get higher. Now, I have to be honest, and we may come on to this. Of course, the consequence of both higher inflation and higher unemployment is that it's those less well-off in society who lose out more. So I think, I understand the consequences and the unpopularity of what I've said, but I think these points, and it does apply to price setting as well. Let me be clear, do have to be said. Okay.
In terms of the links between wages and inflation, productivity is obviously very important, and that's swung around during the crisis, as you would expect, in both directions. What is your assessment with productivity of where it's likely to settle as we come out of here? What do you think the crisis itself might have done to productivity? Very difficult question.
It's a really good question. I mean, and others may. I mean, Jonathan's a real expert in this subject, so I'm not sure he'll want to come in. I mean, I think the big question for us is one of the big questions is what is going to be the impact on the sort of the changed ways of doing things in the economy on productivity? And there are sort of range of views on that. I mean, I don't know whether you want to elaborate on that.
No, I think Andrew's absolutely right. That what we've seen in the very short run is an enormous change in productivity, essentially because some sectors of the economy has been closed down, social sectors, broadly speaking, and others have stayed open. So unusually in the evolution of productivity, the sort of structural change in the economy has entirely driven productivity, and that's why it's kind of gyrated and then come back again. But as you say, Andrew, I think the key question is what kind of structure of the economy do we see in the future? And I'll try and give you a short answer, which is that if we do get some movement towards a more digitally orientated economy, perhaps more online shopping, perhaps more remote working, then there are some tremendous productivity opportunities, actually, because then we can bring the power of the information technology revolution to areas like remote healthcare, to other areas like that. And that would be reasonably promising in terms of productivity. There are some straws in the wind there, in the sense that investment in software and other types of intangibles has held up just about over the pandemic. It hasn't fallen as much as other types of investment. So there's a little straw in the wind that firms who've managed to keep going during these terrible times, may be moving towards that more, as I say, digital online kind of intangible area, and that might be some promise for productivity. But ultimately, it's going to be the investment decisions of firms and which way they decide to go, which is going to be really important.
Thank you. Thank you very much. That's very helpful. Angela.
Thank you very much, Chair. I want to carry on talking about wages for a bit, Governor, and then talk about QE turning into QT. But first things first, can you tell me what the median annual pay for a full-time employee was in the last period, last year to April 2021?
Median annual pay, I think it's somewhere in the sort of upper 20,000 range is the average.
31,000.
Sorry?
31,285. Can you tell me what the median care worker wage was during the same
I know it's
period?
considerably lower. I can't tell you exactly what it is, I'm afraid.
£9.01 an hour, and 77% of care workers are paid below the living wage foundation rate. What was your pay over the same period?
Actually higher.
What was it, Governor?
It's somewhere over 500,000. I can't tell you exactly what it was. I didn't carry that around in my head.
I think including pension, 575,000.
Yeah, including pension.
538 pounds. I think without pension, 477,000. That's how many more times?
It's
than the
substantially more.
average pay?
It is substantially more. I know that.
And do you recognise the ONS figures that real average earnings are now at the same level as they were 14 years ago?
Well, certainly the labour share in the economy hasn't changed much in that period.
So do you think that in these circumstances, perhaps your emphasis on telling workers that they had to show pay restraint was the most important thing to do when you went on the
Well, can I just, come back to what I was saying a few minutes ago and explain the point. So first of all, I'm not saying people should not take pay rises. I did make the point, it was in the context of large pay rises. And my concern, as I said earlier, is the second round effects. That if everybody tries to get ahead of the shock that we've had from outside everybody, then we will get the second round effects and it will get worse. That's the problem.
No, we've had the longest pay squeeze in 200 years, and real earnings are now at the level they were 14 years ago. So if there's never any time when people can have any sort of catch-up because you're worried about the effects of inflation, are you saying that the share of GDP for labour ought to just remain and just be constantly squeezed down because inflation's a problem?
No, I'm not saying that. But I mean, the labour share actually hasn't varied much in the last, I think, 20 years, actually, as a share, that is, of GDP. And I'm not saying that.
But it fell substantially, as we all know, when trade unions are weakened, after Margaret Thatcher came into being, after Ronald Reagan took over in America. And there's been a ratcheting down of the amount of GDP that is spent that goes to labour. That is not some natural level. Surely that is something that ought to be, if we want our societies to become socially sustainable as well as economically sustainable, that we ought to consider putting up again.
Well, I'm happy to have that debate, and I think it's an important debate, but can I just come back to the situation we face at the moment? We've been hit by a very large shock, which is a shock from outside. There's nothing...
Yeah, I understand
but can I just explain the problem? I mean, there's nothing that we can do to offset that shock, and nothing I would say more broadly can be done to offset that shock. That is what we tend to call a terms of trade shock. The prices of the things we import have gone up relative to domestic prices. Now, the risk, as we were saying earlier, is that we then get second round effects setting in. And I just want to reinforce what I said earlier. The real risk here, and this is why I understand why it's misinterpreted what I said about care workers, but can I say again, the real thing that worries me here is that it's those with least bargaining power in the labour market that lose out in this situation, because you've got this shock to national income. It's got to be I'm afraid it's going to hit us as a nation, and in a labour market which of course operates as a market, that's important. it's those who have got least bargaining power that get the worst outcomes in that.
Isn't the problem is it doesn't act as a market? In the case of carers, we see huge shortages. Sorry, Angela.
Go for it.
We see huge
Siobhan.
shortages. People can't be cared for. People can't get places in residential care homes. And at the same time, people's income is in decline relative to the costs they have to pay.
And there's about to be another huge decline, given the cost of living squeeze that we know is coming.
Well, can I just try and separate this? Because I think what you're saying is that some parts of the market work less well than other parts of the market, and I'm not going to disagree with you on that. And what we're also seeing, by the way, at the moment is a market that's functioning with more people moving jobs, I think, to increase their pay. I think we're observing the churn has gone up. So in a way, I think what you're saying is not at odds with what I'm saying, that there is a real concern here that those with the least bargaining power in the market end up absorbing the larger part of this external shock, and that concerns me.
There's no sign of a wage price spiral at the moment, is there, given that there's been 14 years of stagnation and real wages are actually going to decline in the next period, probably by quite a lot?
Well, I frankly prefer not to use the term wage price spiral because I think it's slightly pejorative that the source of this is always wages.
Well, exactly, that was what I was going to come on to ask you. But
which is why I made the point about prices. But our agents are reporting to us, and I don't think we're surprised by this, that there are companies are now striking higher wage settlements. And that one of the reasons underlying that, of course, is what we're observing in realised inflation.
But of course that might give people in our economy, which is based on quite a lot of consumerism, more money to spend in the local economy and actually be supportive of policy. But certainly wouldn't happen if you suppress their wages.
Well, I'm afraid that would be true if real wages were rising, but at the moment that's, of course, and this is the really hard message in the situation we're in, is that this year we don't expect that to happen because of the impact of this external shock and the effect it's having on inflation.
You were talking earlier about making a geographical visit, a regional visit. The GMB trade union has invited you to spend a day shadowing a low-paid care worker. You could make such a sectoral visit rather than a geographical visit. Are you going to accept?
I will certainly go. No, I will certainly.
Are you going to accept their invitation?
I will certainly go to a care home. Yes, because I go to a whole range of. We have 12 regions. We split the country into 12 regions. I commit to going to all 12 of them once a year. We do a range of things in those visits, and I will do that, certainly, of course, because it's an important sector.
Ben and Silvana might have wanted to come in. I don't want to interrupt your flow.
I just want to carry on. I'm questioning the governor. You talked about the profit and the price side. What have you said publicly about companies reducing their price increases, like you've asked employees to moderate their pay?
Well, I'll say this now. I mean, the same point holds for the process of price setting and for corporate margin setting. That's the capital share or the profit share. It's the same point holds.
And so you'd want to see restraint there as well?
Well, I think it's the same point in sort of broader economics terms. It's the same point.
So you can say now before this committee that you'd like companies to think about their profit margins and not putting them up too much.
Yes.
And also think about not raising prices too much.
Well, think is the right word. I mean, and it's a very hard message, I know, but I feel, I can't dictate how people go about this. Of course I can't. But I think if the hard message it has an effect, it's that people do reflect on this risk of second round effects. And the second round effects, you're right, come from both wages and prices.
Well, I hope that employers have heard your messages for them to think about that. What are you going to say about bankers' bonuses? Because we're just in the middle of a huge bonanza of bankers'
Well, the same point holds. I mean, we don't set pay levels in banks. We obviously have remuneration policies which are designed to meet our prudential and financial stability objectives. They're not about levels, they're about the structure of remuneration and getting the right incentives. But the same point holds about on restraint holds for everybody.
So you want bankers' bonuses to be
well, all I say is please
well.
reflect on the situation we're in. That would be my point.
What about executive pay?
Well, same point. I mean, please, when you're thinking about this, please reflect on the economic situation we're in with this very big shock coming in from outside.
So restraint all round is what you're saying, basically, Governor?
Well,
on all sides of these equations.
actually, but can I go, I know others want to come in. Can I just go back to the point I made earlier? This hits the least well-off hardest. So I think we should think about it in those terms. So when I talk about restraints, I think we should bear in mind that a lot of this is frankly my big concern, that the least well-off will come off worse in this process if we don't have, some process of thought and restraint in there.
Thank you very much, Governor. I want to move on to talk about the first toe in the water in converting QE into QT. That's quantitative easing into quantitative tightening for those that don't know the jargon. Can you take this opportunity to sort of take us through how you see this process, which you dipped your toe into recently, playing through, because we are in uncharted waters?
Yes. So we've taken the first step, which was the consequence of raising the bank rate to 50 basis points. And that led to the decision we indicated last August, which was that we would, at that point, cease reinvestment in the gilt portfolio. And indeed, the first reinvestment we won't make is about to happen in the next few weeks. Now, I would say that if we stop there, then the path down is quite gradual. The reason for that is because we've purchased gilts over the years in fixed equal buckets of short, medium, and long. So that restricts, obviously, that sets the path of maturities. Now, what we said last August was that if and when bank rate reaches 1%, and the words are important here, we will begin to consider active sales. So it's not the same sort of quasi-automatic process that we had with the ceasing reinvestment. So we will do that, obviously, when we get to that point. We haven't done that part of the process yet, but that's what we will do. So the 1% is a necessary but not sufficient thing, and then we would have to consider what the right profile is.
What sort of things will you take into account? Because obviously you have to signal to the market, and although it's not an automatic mechanism, it is important that you don't suddenly change the criteria which you're considering. So do you want to say anything else today about other things that you'll take into account in your decision to conclude whether it becomes necessary to do QT rather than not, once interest rates get to 1%?
Yes, I'll say a few things. I mean, first of all, my view on our intention is that we will do this in what I would call sort of normal market conditions. So obviously there's very little experience of QT. There's none here, and there's not much globally. Well, it's beginning to grow. If it's symmetric to QE, then our view is that QE has its biggest impact in times of market dysfunction. If that's the case symmetrically, then obviously we would want to do QT at times of calm markets. Otherwise, it would have its biggest reverse effect.
We all wish for calm markets, don't we,
Governor? No,
but we don't always get them.
But we would want to have a trigger which controlled that, because we could suspend it. That's important from a monetary policy point of view, because it means that we would want to conduct QT at times when its impact on monetary policy was least.
Yep.
My view. Obviously, then we would have to work out what we think at the time is a sensible sort of pace for doing it, so we'll have to do that. And that will obviously involve discussions with the DMO. And by the way, the exchange of letters I had, you may have seen, with the Chancellor when we started the no reinvestment, we flagged that there obviously would be, and we would do that. That's important. The final thing I'd say on gilt QT is that because this gets said quite often, is obviously we've got a very large stock of gilts at the moment. Now, in terms of market impact, it is not correct to think that we would sell the whole lot. I'll come back to why I said market impact in a moment. It's deliberate. And the reason for that is on the other side of our balance sheet to the gilts is reserves, which central bank money, wholesale central bank money, and banks hold reserves for liquidity purposes. It's the highest quality liquid asset you can have. And the demand for reserves has gone up since the financial crisis deliberately, because pre-financial crisis the prudential regime was inadequate. So I would say we know two things. We know that the level of reserves that we have today is, we think, higher than the steady state level. And we know the level pre-financial crisis was way too low and didn't consider financial stability. So the sort of what I might call the equilibrium level is somewhere in between, but we don't know where it is. But we know that we will not be reducing and therefore selling into the market the whole of the stock of gilts we have. Just to be clear, I phrased it in terms of market impact because the second leg of that is, of course, that the way in which the QE portfolio is structured is that it's in the asset protection fund, and the net cash flows go to the Treasury. So obviously there will have to be another leg of this to settle up how we get out. We end that and shift to a different world where it's part of the Bank of England balance sheet.
When that happened, I mean, so far the Treasury's done rather well out of QE. And the
cash flows, about 120 billion pounds.
Yeah,
like
and the sort of other side of that coin, if you're doing QT, is that there might be losses. And you've had an exchange of letters with the Chancellor about the Treasury always making up those losses.
Well, they go back to actually
does that mean that he's going to
Lord
be
King's
on
days as governor when they first said this. So the
but
cash flows.
Does that mean that he's going to be on the phone to you if it's a bit tight in the budget, saying don't sell any assets?
Well, we're an independent central bank.
That's partially what I was getting at.
And that's why it's important to set out to your original point. I mean, that's why it's important to set out the sort of the policy and the profile in advance. Well, that's one reason why it's important to do. The market's obviously important in that respect as well. I mean, what I should say is, it is very reasonable to expect that the cash flows will reverse. And indeed, that you look back at the letters between my predecessors and chancellors going back to the beginning of this, they anticipated that because the positive cash flow to the Treasury reflected essentially the path of interest rates, which were coming down. When you get the reversal of that, the cash flows will turn round. Now, they won't turn around immediately because it depends upon, if you like, the sort of today's rates versus the sort of the rates at which the gilts were purchased. But that will happen. Yeah.
I just wanted a quick question to Ben, because of the decision to unwind the 20 billion corporate bond QE programme through active sales. The minutes don't explain this decision beyond that it reflected specific characteristics of the corporate bond market. Do you want to outline a bit more what?
Only that the maturity of that stock is extremely long. So it would not be possible, practical at least, to unwind it purely through stopping reinvestment and allowing the things to mature. I think we have a couple of 100-year bonds.
97 years.
So that's not going to be resolved in our
lifetimes. You
lifetimes.
have to, it's a slightly different means of unwinding than for gilts. I mean, the gilts portfolio the gilt stock has reasonably long maturity relative to other countries, but not as long as that. So,
I mean, finally, these were launched after the Brexit referendum on the basis that they would offer greater bang for the buck than purchases of government debt. Did they? Or is it too early to say?
I mean, look, we were sceptical economists. You would need to decide that one way or the other, more evidence probably than one single episode. Yeah. But from what we looked at the time, if you look at, for example, the amount of corporate debt issuance after that, it is suggestive that it did have some effect at a time when that market was showing signs of freezing up. But as Andrew pointed out, on the side of government debt, the effects vary according to whether that market is in a sort of liquid state, in which case our buying or selling small amounts probably don't do as much, or whether it's illiquid, in which case if we come in as a market maker on either side or we buy and sell stuff, it would have more effects. Our judgment is at the moment that corporate bond market is working reasonably fluidly So we don't expect the sale of what is in any case a relatively small number of corporate bonds to have much impact.
Yeah, thank you.
Thanks very much. Can I quickly go back, Andrew, to you and this discussion about the reverse flow, if you like, away from the Treasury as QT kicks in. Did I hear you say something around maybe reviewing the way that was accounted for?
No.
That's fine.
Oh, sorry, no.
You were saying something and then you were...
No, my point was this. No, not reviewing the way the asset protection fund works, no. My point was this, that at some point, we're going to, as I was saying, we're going to hit the sort of the steady state stock of reserves. And they have to be matched by assets on the Bank of England balance sheet, which will most likely be a stock of gilts. So we're going to have to find a way, and this is part of the thinking we'll have to do then, to transform that from a stock that's held in the current form, which is indemnified by the government, in which the cash flows then go to the government, to something which is held by the Bank of England because it's the backing assets for the reserves, for reserves. Now, we're going to have to do a number of things at that point, because we're going to have to then sort of find a way to effectively sort of transfer the value of that, settle up the sort of the future, the estimated future obligations, and we're also going to have to work out how we account for that in the Bank of England balance sheet. So we've got quite a lot of work to do, frankly, on that. I mean, I would be very surprised if we hit this level, in the near future. I mean, we should have quite a long way to go before we get to that point. So my point is not about the accounting for the system we have today. It's how we move from that system to the to what you might call a sort of steady state world of the future. Yeah.
Thank you. Shana.
Good morning. So I've got some questions on forecasts and interest rates. For all of you, this question, do you believe your own forecast? And if not, what else is guiding monetary policy? I appreciate you've touched on some of the issues, but given the rising inflation rates and all that's happening, how much confidence should we have in the forecasts? And how much do you have?
I'm happy to start off. I'm sure the others will want to come in. So yes, I mean, look, it's the central case for us. And I think a key point, and let's go to energy prices for a moment, because it's a key point. The convention we use for forecasting, or for the forecast for energy prices, is that we use the first 6 months of the market and then we hold it constant thereafter. Now, actually, the first 6 months currently is quite flat, and I'll come back to that in a moment. So it's a reasonably flat profile. It comes off a little bit, and that's a reasonably flat profile. That's one view. Forecasting energy prices is inherently, challenging, let me put it this way, particularly in the current environment. So we did present an alternative forecast, or an default scenario, I should say, sorry, which took the market price of and this is particularly relevant to gas. And you'll see that in the NPR. And that showed inflation falling faster and actually going below target. Now, what do we, to your question, I mean, which one do we believe? Well, they're both relevant. And the way I think about it is this. We've got a central case. As we said, we've got two-sided risks. Yeah. We've got an upside set of risks, which I would say really now come from two things. One, as we were discussing a few minutes ago, second round effects in wage and price setting. Unfortunately, I think we've also now got an upside risk on energy prices from worse things happening in Ukraine. Yep. We've got a downside risk going further out, which is if you like, is the alternative scenario, which has then energy prices. Energy prices, as Ben has said to us many times, do tend to revert to mean eventually, and the market takes it towards there. It doesn't actually take it back to the mean.
Does that raise the question that, given this very significant underestimate in terms of inflation this year, given all that's happening, there needs to be a rethink about how forecasting happens? Or do you think the current mechanism for doing what you're doing is fit for purpose?
No, I don't think it needs rethinking, but what I would say, and I'll speak personally now in terms of my own thinking about how I then use that in the interest rates decision-making processes, that I think the risks at the moment are larger, and therefore have a larger certainly impact on my own thinking.
Sorry, Rashad, very quickly, because it's on that specific point. So where the modelling, where you take the alternative modelling, where you take the future market price of oil and gas, etc., going forward after the 6 months, where today, what's happened to that curve, given what's happened in the Ukraine?
So,
how
that's
much has it shifted?
What's happened is that if we go back to November, the November NPR, I think I'm right in saying in November, we still had take gas prices, we still had a curve that actually came well down by this summer. Now, I think the way I would rationalise that at the time was that we knew that in Europe, gas storage levels were very low going into the winter. So there was a sort of story about a risk to gas prices in the winter, which was sort of amplified by having a low storage level. But then obviously as you come out into the summer, the price comes off, because you don't need as much gas, and you sort of hope that's the point at which I think they usually replenish the storage. Now, unfortunately, what has happened since then is, to your question, is that the curve has flattened in the sense that the prices further out have come up a lot. So that we now have a curve that doesn't really come off for 18 months. The last time I looked at it, which was earlier this morning. And so it has changed a lot. So I think I'm right in saying between November and February, sort of the summary number for the movement in the relevant parts of the curve is about a 30% increase.
Would that mean that under the alternative model, the inflation expectations would actually now be higher than those where you? Well, by the way, sorry, the February alternative model factored all of that in because it was the curve as in February. I was thinking more about.
But what it means is that obviously the downside risk from prices coming off is being pushed further out. And just to finish, I think the only reason I can sort of really adduce for this is Ukraine.
Well, this chair read my mind.
Sorry.
So well, because I was going to come on to the last 24 hours and the fact that we've had the announcement with the German government and Nord Stream, the reliance on energy. Other colleagues are going to come in on the international perspective, but given the even greater external pressures. I suppose one of the challenges here is that we've already seen an underestimate in terms of forecasts. How are you going to stay ahead of the curve in terms of, rather than playing catch up, which is what some commentators, including some commentators have started to accuse the bank of being in a position of appreciating the context in which you're operating and some of the things you've said earlier.
Would you mind if I come in on that?
So can I just get the response from Governor, and then you're all very welcome to come in.
Well, it's very hard for us to forecast sort of geopolitical events. I mean, that's the real problem we have.
You saw it coming down the line. In fact, you've mentioned it in previous sessions, Ukraine and external, geopolitical points.
And that's why we use market prices, because the markets obviously do, take on board that information. What we don't have is sort of, private information on what Mr. Putin may do next.
Yeah, but energy prices and the reliance on Russian.
The market, there's full of professionals who are extreme experts on energy markets, who are paid to think about the developments in that market and what future prices will be. No one could have done better than that market, and that market was way off, miles off in what future energy prices will be. So if you go back, say, to the point at which monetary policy might have been able to do something about gas price inflation and its contribution to CPI. So given the lags that Silvana was talking about, to have offset this now, we would have had to have tightened policy aggressively in the summer of 2020. Okay, so that's the kind of time horizon you're talking about. Now, at that time, if you look at what the market was expecting the price of gas to be now, so I asked these experts.
It would have had to be done in 2020.
Yeah, but not only that, but if I asked them, they said, what is look at that market and see what it was predicting. The spot price of gas to be right now, the answer is something, I think, around 40 pence a therm, and it's now close to 200.
My question was touching
so we
on
don't
the current
forecast
context.
That's the point I'm trying to make. When you say, can you change the
It's not a
forecast?
personal criticism of you. I'm trying
No,
to
but-
get you to
No,
reflect
sure.
on
But
some of the
this is
observations.
I'm trying to answer the question specifically about should we change the way we do the forecast. And my answer is no. I don't think we can do better than to take the market price in general, whether that's, and we do it for the currency, we do it for oil, we do it for gas.
Okay.
And that is the answer to the question. So when you say, we don't forecast those prices, we just take what the market expects.
Okay, but there's a broader issue, and again, I'm going to play devil's advocate. You'll probably not be very happy about it, but I'm going to say it. There have been some commentators that are arguing that Threadneedle Street has fallen badly behind the curve, to quote, miscalculating the rise of inflationary pressures and now needs to play catch-up to regain credibility. Andrew Sentience, a former MPC, a committee member, is quoted to have said they've sent conflicting messages on monetary policy since last November, and they seem to have lurched from being very cautious to being seen to want to act, but it's still not clear what strategy they're going to be following in the future. So for all of you, do you feel that this is, that there is a strategy given all these external challenges? Is it even possible, given we've, since the pandemic and all the Brexit shocks, we've got a £20 billion decrease in exports just in the last year, COVID, now geopolitical issues. And this is not about pointing the finger, it's about just trying to understand whether you feel that you've got everything in place to be able to respond to these really huge challenges. Silvana.
So, you're right, this is a huge challenge. And just to start from the basic, the most straightforward role for monetary policy is in offsetting inflation triggered by demand shocks. That is, shocks that push activity and inflation in the same direction. At the moment, as well as some demand-side pressures, the UK economy is facing a huge supply-side shock. Yeah. As you rightly pointed out. And just to be clear, monetary policy can offset the inflation impact of a supply shock if hypothetically it knows about it well in advance, as Ben was saying. It cannot reduce the price of energy, but over time it can affect the prices of other goods and services so as to hit the target. Now, the reason that supply shocks are not straightforward and so challenging is because they create a trade-off for monetary policy. The increase in energy and tradable goods prices pushes up on inflation, but also lowers real incomes and real activity. And this creates a trade-off for monetary policy. Returning inflation back to target too quickly could destabilize economic activity and employment, reducing output below its potential and causing an increase in unemployment. So the MPC remit is contemplating very explicitly this type of trade-off shocks, and it recognizes that on occasion the inflation rate might depart from its target as a result of these shocks and disturbances. And in those settings, it acknowledges that attempts to return inflation to target might come at the cost of output volatility. The remit goes even further and acknowledges that in some exceptional circumstances, these shocks might be larger or more persistent or both, and in those cases, the MPC has to trade off has to manage those and decide the speed with which it returns inflation to target, taking into account the cost in terms of output volatility. So the question for us now is how best to manage those trade-offs. And let me just add that these supply shocks are nothing new. In some sense, we were in trade-off territory with in the aftermath of the financial crisis and following the Brexit referendum. What is unprecedented, at least since in the latest decades, is the size of the shock.
Would it be appropriate to characterize what you're saying as you're basically backed into a corner with very limited, and given the external points, given all that's going on, with limited room for manoeuvre?
Well, we need to manage that trade-off, so it's in the best way possible, and it's a huge shock, and it's going to have a big hit.
Emphasise what Silvana said about the size of this. I mean, if you look at the increase in energy bills this year, it's just about twice as big as any single year in the 1970s. I mean, it is enormous, and that is the challenge. There's nothing we can do about that directly, but as Silvana says, we have to think about the horizon over which that shock peters out. And as for the strategy, I mean, the strategy is the same as it was when Mr. Sentence was on the MPC. It is, we have a forecast.
No, these people, when they leave, they get very vocal, don't they?
But that's my answer to the question, is what I'm saying.
So
I think it's the same.
But is the strategy fit for purpose still, given all that's going on?
Yes, it is.
Okay.
I mean, these shocks are enormous. They're the biggest, the MPC, even bigger than anything Mr. Sentence faced when he was on the MPC. And we have to manage them in a similar fashion.
He's not re-invited to reunion parties.
No, but I'm just saying that, that I think is one of the key points to get across. And it is immensely challenging, and it sort of relates back to some of the things we were talking about earlier. We're talking about shares of income and shares of GDP. This is a huge hit to real national income. There's a question we were looking at earlier about, why is it that real incomes are weaker than GDP? And the reason for that is that real national income, doesn't happen very often, is much weaker than GDP, because the prices of what we're consuming are going up much faster than the prices of what we're producing and selling. And that's the nature of this terms of trade shock. It's the nature of the huge rise in import prices. And that means there's a big squeeze on real incomes. And so we're facing a situation which is very clear in the forecast, where on the one hand, inflation stays high, not forever. But on the other hand, domestic spending growth is weakening in the forecast, unemployment starts to go up. And that is precisely the kind of trade-off that policy has to think about. But so in its nature, it's not different from what we've done, and I don't think the way we have of viewing it or forecasting or trying to manage it with policy should change, but the scale of it is completely unprecedented.
I did say I was being provocative.
No,
so
indeed, but I was trying to answer the question.
Just go on. I mean, is the framework in our remit, which is contemplating those shocks. I guess it's the size that is extreme.
Just one small thing, if I may, just to complement Ben's remarks about the scale of it. The share of energy, oil, gas and so forth, in the whole consumption basket is only 6% of the consumption basket. But its contribution to the rise in inflation over the last year is almost 50%. So just a 6% share gives you almost explains almost half the rise.
More than that in recent months.
But that data was, for the record, was for the rise over 2021. But indeed, Andrew, I should say that's
it's about 70% in January, we think, in the sort of first quarter or so of this year.
So wouldn't it, given this tight spot you're in, with the inflation being basically way off target and it's going to continue to go up, isn't it the case that this is something where you've got limited scope in what you can do, and it requires policy intervention by government if we want to do anything to address the pressures, the energy price pressures on consumers? There's not really a great deal, is there, that outside of policy that can be?
That's for government to answer. Sure. What I would say, however, is that as I think all of us have said during the last period, there's nothing you can do to lose. This shock can't be hidden away somewhere. It's a shock to national income. So it's not for us to say what government policy would be, but I would simply observe that there isn't a public policy that can lose the impact of this. In that sense.
Yeah, but you're not. I suppose what I'm saying is you're very limited in what you can do here.
Well, if I can come in, if you'll forgive me.
Sure.
I mean, we're focused. Our job, our remit, given by you, is on the average inflation, is on the inflation rate, the average inflation rate. Now, you're absolutely right, and Andrew was saying this earlier on, that changes in inflation affect different people at different stages of the income distribution, retirees, non-retirees, and all that kind of thing. But that's not something for us. Although it's obviously very important that campaigners have
since the governor opened up the
away.
Conversation about wages and the earlier conversation, I suppose I'm taking it as permission to be able to give for us to think more broadly about the role of where government. I'm not saying you should. I'm not asking you to recommend to government, but this is an issue that's exercising all of us in terms of the impact on citizens. And that actually, that's an area that government needs to address if it wants to do anything through policy to try and take the edge off the pressure on consumers in terms of inflation and fuel price increases.
I say this as an observation, not as a piece of advocacy, because it isn't. I think I observed at the last hearing we had that if you take the household survey and split it into deciles by income, the lowest, the bottom decile, I think, spends around about 7% of its income on energy.
Exactly.
Yeah.
That's around about twice as much as most of the other deciles.
Yeah.
Which is why there's a really break in the number at the bottom decile.
Not literally violent, but violent reaction to the comments about wages, because people are feeling the pressure on the cost of living.
But that's my concern.
So
Look, just to reiterate what I said, is my concern is that in a second round inflation effect process, it's those who have least bargaining power in the labour market who get hit more.
Yep.
And just to add the observation I've just made, and by the way, because I'm afraid it probably would be concentrated more at the lower end of the distribution. They're spending more on energy.
Yes.
We can't
I've got
observe
a couple of questions on interest rates.
So I can observe it, but I'm afraid we can't. Obviously, we haven't got the tools to.
Sorry, Silvana.
Yeah, just related to this and going back to Dame Angela's questions, the Bank of England doesn't have any influence on how workers and firms share the losses or gains. And if workers want to negotiate higher real wages at the expense of profits, that's completely independent of monetary policy. Where monetary policy steps in is when it sees wages and domestic prices accelerating together. And that's our, the role in which distributional issues are for government.
Yeah, no. Absolutely, and we'll move on. We'll move on to interest rates. So we've had ultra low interest rates for the last 13 years, but with inflation soaring, are we going to see an end of an era with ongoing interest rates for some time to come, to increases for some time to come? Perhaps I'll start with Ben.
I don't know. I mean, I doubt we're going to get back to the levels we had in, certainly not the levels when the MPC first began in 1997, still less those that prevailed earlier. Ultimately, what's required in terms of the level of interest rates depends on, we've used this technical term, the equilibrium real rate, set really in global markets. That has definitely come down over a period of many, many years. I would argue in this country it's been going on globally actually going on for at least a quarter of a century, that process. And our understanding of the sort of things that have probably driven that decline is that they're unlikely to turn around very dramatically. They may at some point. And nor are they really connected with what the inflation we're seeing right now. We've spent a lot of time talking about energy prices, other prices of other global traded goods. A lot of that's connected with the pandemic. It's not really done anything to change my view about those longer-term factors. Now, we have said that we think we're going to need probably some further gradual and limited rises in interest rates to ensure a sustainable return of inflation to target in the medium term. But I don't think that means some inexorable and never-ending rise back to the kind of levels that prevailed before. I think that's pretty unlikely. So we don't pre-commit to some level. We don't say, this is where we're definitely going. But if you ask me to guess beyond, we can talk only in very broad terms, I think it's pretty unlikely that interest rates will have to go back to those sorts of levels that were there, 20, 30 years ago.
Yeah, but what should we, people have got used to having low interest rates.
Yes.
So what do you think is likely to happen in terms of the impact on the way that people have experienced it, whether it's mortgage interest and so on, and how that impacts on the wider economy?
Well, we spend a lot of time thinking about how policy works, obviously. So I don't see any particular reason to think that these changes will have dramatically more impact than a change would have done, 2, 3, 4, 5, or even 10, 15 years ago. And in fact, if anything, with reference to some very specific channels, like, say, the mortgage market, actually the process is likely to be slightly slower and more moderate in the first instance, partly because there's you've got to remember that fewer than half of households have a mortgage. And B, those that do, there are many more fixed mortgages amongst that population. They're not fixed for 10 years, but they're certainly fixed for 2 or 3 years. And
households and businesses who've relied on low interest rates shouldn't have such unexpected surprises or large rises. There
will be some. And on the other side of the other committee to which Andrew and I belong, or one of the others, the Financial Policy Committee, spends a lot of time thinking about the tail of the distribution and those for whom debt costs, whether it's mortgages or corporate debt, form a high proportion of their income. And there may well be some increase in that population. But overall, and the MPC is certainly concerned more with the overall, I don't think, my own view is that we'll see, but the necessary rise in interest rates will be so dramatic that it takes us back to the levels that prevailed, as I say, 20 or 30 years ago.
It's not going to be dramatic. What sort of numbers should...
Well, I'm not going to give you a number, because we will do what is, the important thing, coming back to Silvana's remarks about the remit, is that we do what is necessary to ensure a sustainable return of inflation to target over the medium term with least real cost to the real economy. And we've talked a lot about the unpredictability of the shocks that come along. It's crucial to remember that our job is to respond to those shocks in as much as they affect our projections for the medium term. And so to pre-commit to some level of interest rates would be the wrong thing to do in the face of all these shocks that come along.
No, I appreciate that. But given the way in which inflation's kind of come as a big shock, I suppose what I'm getting at is people will want some reassurance that, they're not going to see very high levels of interest.
Well, I've tried to give as much as I can, but I can't what I'm saying is I can't say here's a number beyond which we will never go.
So as Ben says, we cannot pre-commit to a level of rate. And what I can say is that the best thing is to look at our forecast and the updates of our forecast. So currently, our forecast suggests that if we kept interest rate at 50 basis points indefinitely, that would create an overshoot of inflation in year 2 of 60 basis points, year 3 of 10 basis points. So that suggests that some more modest tightening, and really modest, would be needed to return inflation to target over the forecast period. So that's the range of magnitudes as of now. But of course, there is a lot of uncertainty around that, and Ukraine, as we just talked, is one big factor that might play out. Now, just to remind, just before the pandemic, rates were at 75 basis points, inflation was below target, and unemployment was very low. Labor market was tight, at least in quantity metrics, if not so much on the wage side. But so many things have changed since then. But not dramatically, as Ben said, nothing structural to change significantly, in my view at least. But again, it's important to keep the uncertainty that we cannot give a concrete.
Thank you. I don't know, Governor and
I was thinking,
Haskel,
actually, at the moment, Silvana's actually said most of it. I was just going to repeat the words that we used in the monetary policy statement, which is further modest tightening is likely to be appropriate in coming months. And that's the position. Yeah.
Coming months is the point, isn't it? People are thinking what's going to happen next year and the year after. But I appreciate what you're saying.
Yeah, I mean, I think I said in the press conference we held when we issued the report. I mean, I would just repeat those words because it is a message to markets not to get carried away. I mean, it's the same message that Dave Ramsden gave in his speech yesterday.
Okay. Jonathan, did you want to?
Nothing to add, but thank you. Yep.
Thank you very much.
Thanks, Rishna. Kevin, please.
Thank you, Chair. It's a similar theme, actually. If I can come to you, Jonathan the Hawk Haskel on the NPC. Yeah, you were voting for a higher increase than everybody else. And how high do you think interest rates can go to reach kind of equilibrium level?
It is. Thanks for the question. It's a similar question to what you said before, and Ben gave the answer, which is that it's difficult to commit to a long-run path of rates. The equilibrium interest rate, as Ben was saying, determined on world markets, has fallen probably for the last sort of 30-odd years. So we're not going to get back to the 1997, the establishment of the committee types of levels. But as Silvana has just said, if we keep rates constant, then we're going to overshoot in both the inflation target in both year 2 and in year 3. So they're going to rise. They're certainly not going to be constant in order that we hit the target. And that, again, to emphasise that, as all my colleagues have said, it's hitting the target, which is the most important thing for us.
So I think the bank analysis in 2018 estimated the equilibrium nominal interest rate lies between 2 and 3%. Is that still valid?
I think it probably is. I don't know that there've been comprehensive recent studies on all of this, but it probably almost certainly hasn't gone up relative to that. If anything, it's probably gone down.
So you could see interest rates kind of settling at that level at some point over the next few years.
Well, again, I really don't want to commit because I don't think that would be right to commit to a kind of long-term path.
So we haven't done new analysis on the equilibrium level of rates. The figure you cite is capital R star, the long-term equilibrium rate. We also discussed in the same issue of the NPR the concept of short-term equilibrium rate, which is a more medium-term measure. And at the time, we thought that it was much lower than the capital R star. So it's more the cyclical component. So there's a distinction between that long term, which might be way beyond our 3-year forecast period, and the R star for the medium term or the forecast period, which is affected by many other cyclical factors. And at the time we were discussing, it was definitely battered by many factors that were lowering it down. And that explains why in the period pre-pandemic, we had inflation at target or below, just before the pandemic, and unemployment was at, in equilibrium, at its equilibrium rate. So there are these two concepts to keep track of: how, little R star, or the short-term equilibrium rate, evolves, and then the long-term, which is a more structural variable. That, as we explained in that report, it was. What drove those changes were demographic changes, changes in productivity growth, and those longer-term issues have not really changed with the pandemic. So those would tend to keep equilibrium R star relatively low.
Sure. I mean, Professor David Miles who's obviously now with the OBR. Said there was misplaced confidence that interest rates couldn't go to 3 or 3.5%. Is that fair, or is that being too pessimistic?
I don't know what horizon he was talking about.
He was talking about dealing with inflation in the shorter term rather than the longer term demographic issue.
May I say sorry?
Yeah,
So,
of course, you've got,
sorry.
no, yeah, we were just talking about how high interest rates.
No, I
could
don't.
go.
I mean, I'm thankfully not in the business where I have to forecast what interest rates are going to be in a year or 2 years. I mean, it may seem odd because there's on the committee that does them, but our job is at each point in time to say what is the outlook for inflation and to set the current level of interest rates accordingly. And that's the best approach, because our objective is not to make a particular level of interest rates more or less uncertain. It's to control inflation in the medium term. So I don't know what will prove necessary. As Silvana was saying, we live with very low interest rates without inflation. The factors that the implication is that equilibrium rate had been falling, certainly since, say, the 90s. My own view is that the factors that drove that are unlikely to have turned around very dramatically. But that doesn't mean I can tell you exactly what interest rates will be, or I don't, I mean, David's...
No, I guess it's all predictions about the future are difficult to make, aren't they? Andrew, I can see you itching to come in. And
No, not particularly. No, I was...
Put it in some context. I mean, I know this is a more strategic line of questioning, of course, rather than the immediate issues that you're facing today. But obviously there's a dependency in the economy from both consumers and businesses in terms of who have become reliant on very low interest rates. You've got people like... I know you're lots of different people making predictions about the future. Professor Charles Goodhart, who talks about the great demographic reversal, China's ageing population driving inflation effectively. Are we going to put ourselves in a vulnerable position where people have been used to those very low interest rates?
Linked together what I was just about to say on that. I mean, Silvana, I think, very rightly set out what I would call a sort of a very helpful framework for thinking about rates in the medium term and then in the somewhat shorter term, but it's only a framework. It doesn't tell us the answer meeting to meeting. Now, Silvana mentioned that the sort of longer term drivers were demographics, population growth, longevity, and then productivity growth. I mean, Charles Goodhart takes a different view on those long run growths. I don't particularly agree with him on those points, and actually our former colleague Jan Vliega made a very good speech on that subject towards sort of middle of last year, I think. But Charles's different position is because he takes a quite different view on those long run, what are called drivers of what Silvana described as trend R star, the capital R star.
Yeah, okay. I mean, the other issue with this, of course, is keeping interest rates very, very low limits your room for manoeuvre in terms of stimulus, in terms of monetary policy. We had a number of economists come to talk to us a week or two ago. Jim O'Neill, Roger Bootle and others, Professor Charter, all talked about neutral interest rates should be between 2 and 3%, not this. Is it possible we can get back there to give you more capability to manage the economy more effectively or manage...
You don't create a recession to have more room later.
Yeah.
So
Sorry?
you don't create a recession to have room.
You think that's
more.
what would happen?
If you hike rates just for that reason, you would tighten the economy to the point of driving it to recession, and then of course you will have some room to lower rates later to fight an even deeper recession, but meanwhile you kept everyone on a recession all these years. So I don't see the logic of the ammunition personally.
Okay. So you would see that the path of interest rate in terms of the risk to consumers and to businesses, which is significant from potential high interest rates, is that those risks are potentially overblown by people saying that rates could go to those levels?
Just for the ammunition reason, on its own, doesn't stand together. That's all I'm saying. You set interest rates, as Ben was saying, in order to hit the target of inflation, and subject to that to minimize disruption to output and employment. I mean, that's what our remit is telling. Our remit doesn't tell us build ammunition. That's.
Any other thoughts on that same thing?
No, I fully agree with that.
Thanks, Kevin. Emma, please.
Thank you very much, Chair. I'm going to start on a slightly unusual point. But you said, Jonathan, something which really interested me, and that means I can return to one of my favourite subjects, which of course is Hull, which is about the productivity gap and remote working, because you're the only, other than Martin Sambu, who also talked about it in the FT, and he was talking about remote working as a possible way of raising productivity in different regions of the UK. You're the only person I've heard mention it. I just wondered if you wanted to elaborate on that point a little bit.
Well, no, thanks very much. We don't know the answer yet, you know, how this all shakes out, we're not quite sure. One thing we have seen, going back to the investment numbers we've talked about, is there's been a very substantial fall in investment in commercial buildings. So that looks like we may have a rather more long-run structural change, back to the earlier discussion, a rather more long-run structural change towards more people working from home and all of that. Now, we think that that may increase the level of productivity from people working from home, but depends upon the different tasks and all of that. It's quite a complicated picture, kind of early to say. So there may be a straw in the wind that might be a potential way of raising productivity.
It's really interesting because Martin Sambu, when I was talking to him about it, he expressed surprise that in the government's Levelling Up white paper it had made no reference to the idea that remote working could in some way address some productivity, lower levels of productivity in some of the regions. Did you feel the same way?
I haven't really thought it through in terms of the sort of levelling up issues. I mean, the difficulty, of course, is we also think that one of the important determinants of productivity in regions is the cluster of activities in those different regions. And I think where that takes you is to the nature of jobs in different regions. So jobs, of course, to talk about the productivity of a job is not very helpful, because a job is a bundle of tasks. So if I've got a task as I don't know, a call centre worker, with a relatively small number of tasks which I can either do at home or the office, it probably doesn't make too much difference. If, on the other hand, my job consists of a bundle of tasks, which also mean interacting with colleagues and all that kind of thing, it may be much more geographically dependent, at which point the cluster of activities and the region where I'm in is going to be more important.
I'd love to, I won't get sidetracked on it now, but I'd love to explore it in more detail, and be grateful of any further thoughts you have on that issue. And also, Governor, I was enjoying you talking about the need for greater bargaining power for the lowest pay, because it sounds like a wonderful advert to join a trade union. Yeah. So I thought that was really well put there, Governor.
Oh, you'll get me into trouble again.
And so say all of us in what I can say on that. Greater bargaining power, let's do it. But I just wondered if I might turn to the issues around the tightness in the labour market, because I was reading this extract which really concerned me, and I'm going to quote it now, and I'll tell you who it's from. The Institute for Employment Studies Labour Market Statistics. And they've said, worryingly, new data today on employment for disabled people also suggests that the employment gap between disabled people and non-disabled people is widening, as unsurprisingly is the gap for people aged over 50. Those who are most disadvantaged in the labour market before the crisis, and particularly those with health conditions, appear to be faring worst in the recovery. So I just wondered how concerned you are about the drop in labour market participation and inactivity levels, especially amongst older people.
Can I come in? Oh, is that
directed at you? I'm happy to talk. Jonathan's absolutely bursting to say something, so I'll come in.
Well, so hats off to the Institute for Employment Studies. Tony Wilson there has done sort of fantastic work on all of this. I think, my understanding of what he said is we've got about a 500,000 person participation gap. Of that, around 230,000, if I remember correctly, is people who are short or long-term sick. Yeah. And then in addition to that, sorry, I've got the figures buried here, but so I'm speaking from memory now, so forgive me, a number of the over 50s as well, the participation gap. So there's a multi-dimensional thing. What I did want to say is what's interesting and difficult to interpret about that from a policy point of view, which is where you're going, which is not something that we should talk about, but just simply from the data point of view, is the reasons for that participation gap have changed a lot over the pandemic. So in the early period of the pandemic, it wasn't so much sickness. It was much more students. It was people who were, looking after dependents and all of that kind of thing. Now, as we've got to the later period of the pandemic, it's become much more concentrated amongst older people and much more concentrated amongst people with ill health. So again, I think it's back to the earlier discussion. There's not much monetary policy can do about that. But the reason I just wanted to come in, forgive me, is that I think what makes it sort of rather difficult for us to decode that and then set monetary policy is the reasons for that, as I say, have waxed and waned over the period. Sorry.
I only had two thoughts. I think, first of all, amongst this, in this group that's not has come out of participating in the labour force, particularly the older group, as it's more concentrated, and as Jonathan said, it's very hard for us to assess whether that group has wants to come back into the labour market, or has reevaluated life and decided to retire earlier. We just don't know. We don't know, certainly.
Okay. I mean, it's a natural feature of downturns that labour force participation falls, and then it catches up over time. So there might be still scope for some catching up, and the possibility of working from home, elective working from home, could be a good opportunity for for people with disabilities, for example.
Exactly, that was going to be my second
point. To really
point.
maximise their.
I mean, on Silvana's point, I think what we have seen, because Jonathan referred to it, is that this sort of coming back into the labour force has happened for those younger people who decided to spend longer in full-time education. Which makes a lot of, that's a sensible and natural thing, and as Silvana says, that's something we've seen before. I was going to actually reiterate the point Silvana's just made. Of course, and it's not a monetary policy point. We need, of course, to see as many people participate now as can, because the labour market's very tight. So I hope, to your point, that creates a greater incentive for people to think seriously about how you can employ people, with disabilities and so on, because that's important for all sorts of reasons.
What are the repercussions that you can see if older workers leaving the labour market and there's higher levels of economic inactivity? What can that have on the longer term outlook if this continues, if we continue seeing older workers leaving the labour market in the way we have?
Well, like you're trying to say something.
No. I'm just. I mean, the labour. In short, the labour market will be tighter than it would otherwise be.
There will be some demand repercussions as well. Exactly. Activity will shrink, so we will see, compared to the counterfactual, we will see lower activity. But in terms of the impact on inflation, it's unclear because obviously with lower incomes, the demand will also fall, and where that balance will sit is a quantitative question.
I mean, we have seen, Silvana mentioned the cyclicality of participation, and to be clear, it has recovered, right? So the last year it's been rising, not falling.
Okay.
Now, in participation has, I mean, it's not back to where it was, right? So there's still a sort of shortfall, which is the source of what you're saying.
I was referring particularly to older people.
Yeah, no, forgive me. Yes, and I was talking about the aggregate.
It's become more concentrated in older people, I think.
And the other point I make is that the bigger trend, rather than a change in the, let me try and explain what I'm going to say. Over the last several years, many years, we've had an aging population. And so even for a given date of retirement, as it were, the workforce would tend to shrink because there are more people retiring than coming in. So that's been the underlying trend for quite a long time, because we're an aging population, until the pandemic. That had been broadly offset by actually the opposite trend to the one you're talking about, the people staying in the labour market for longer. And we don't know yet. So, I mean, it would be a change if that stopped happening. So even if you don't get a lot of earlier retirement, if you don't have this continual process of people continuing to stay in the labour market beyond the conventional retirement age, which is the trend we've seen for the last 20 years, then we'll start to see the labour market shrink. The labour force, forgive me. on a more trend-like basis. And as Silvana says, I don't think the implication, we always think about what are the implications of X, Y, or Z for an inflation. I don't think there are direct ones in that sense. It's a sort of real phenomenon. It would mean lower trend growth in the economy and in aggregate. So that would be the implication. And, you've seen that in other countries, certainly in Europe, where lower rates of workforce growth have been a contributor to lower rates of aggregate economic growth.
So therefore, do you think it's something serious enough for the government to look at responding to it and taking, I'm not asking you to say what action the government should take, but do you think it's this trend towards people over the age of 50 leaving the labour market, becoming inactive and not returning, do you think it's something the government should be responding to because of the economic consequences you've just outlined?
Well, I don't think we're far enough out of COVID yet to really know how this is going to sort of settle down. I mean, let's face it, we're still only just coming out of the latest wave. So I think we need to sort of see some more time before we really know the answer to this question in the longer term.
And it would be important to understand why people are not coming back.
Yes.
If it's, a personal decision versus some impediment that is making it difficult for them and could be lifted somehow. But so I think, it requires, more research into the causes.
And the missing element, just to add to that, if I may, is long COVID. We actually don't know whether long COVID is disproportionately affecting, just as we were saying, those people, as Silvana was just mentioning, who might be withdrawing from the labour market because we haven't kind of matched up the data with the labour market status and the long COVID status. But I believe those studies are underway.
I mean, the other thing to just say as well is that we have had, and as we've said at previous hearings, I think quite a large build-up in unanticipated saving in the economy. It's not evenly distributed, we think, although we don't know a lot about that. And of course, it's possible that some people are, for a period of time will treat that as a source of income and then will return to the labour market. We don't know.
It's interesting, going back to that, the Institute for Employment Studies, it mentions in it people leaving due to ill health or retirement, as well as people leaving at the end of the coronavirus job retention scheme. So it does seem to be big question marks then over whether these...
There's a lot of question marks on that, yes, I think.
Okay, so maybe...
Yeah, I think what's interesting about that, though, is the trend of people reporting ill health. It's pretty much unchanged since even before COVID, because that's been on a trend increase before COVID. So the difficulty, you'd think, all these people not working, it must be long COVID. But actually the trend, as I say, of people reporting ill health is more or less, which has been an upward trend for sort of 20 odd years. I think in that Institute for Employment Studies document, it documents that that's more or less the same, actually.
Actually, Jonathan, in a recent speech, you said the bank rate will have to rise if the labour market stays tight. Can you elaborate on that?
Yeah, so thank you. I mean, it goes on to what we were saying earlier on, and what I talked about in my report to the committee, and Ben also talked about this much more crisply than me. That if you go back to sort of October, November, which is when I was making the speech. What we had some sense of wage pressure building a little bit, but unemployment, normally a pretty reliable indicator of the amount of pressure at wages, had risen only a small amount over the course of the pandemic. But we had, as we mentioned earlier on, 1 million workers on furlough in the week before the furlough scheme. 1 million workers on furlough. That's an enormous number of workers, right? And so we just didn't know then, I think, just how quite how tight or how loose the labour market was going to be. Maybe those 1 million workers, once the pandemic was over, nobody wanted to go to restaurants and nightclubs anymore. It was going to be very difficult for them. In which case, for us to have raised rates would have been a horrible thing to do, because there would have been a lot of slack in the labour market. Now, as it turned out, that worked out to be much better than that outcome. So what I was trying to say in that speech is it was very difficult to detect what labour market pressure was last year. As it now turns out, we think the labour market is quite tight, and therefore the policy implications from that follow.
Just on that, you said the labour market's quite tight. That's a mouthful. How significant is that as a problem? How tight do you think it is?
Well, it's not a problem. It's a good thing having a tight labour market, in the sense of, there are good opportunities for people around. Just to give you some sense of it, the ratio I rather like is the vacancy to unemployment ratio. Exactly. So before we went into the pandemic, there were roughly 2 unemployed workers chasing every vacancy. Now there's roughly 1 unemployed worker chasing 1 vacancy, if you see what I mean. So there's much, less competition for vacancies. So that's obviously good for job opportunities. But we have
regionally available, and if they're not all located in certain geographical areas, which goes back to our point about remote working.
Indeed. So we looked at that extensively last year. I'm not sure whether he's updated that, when we looked at the various mismatch indices, which we looked at I can't remember whether they were regional or an industrial basis.
We had some evidence on regional, but much less, because the vacancies numbers it's hard to split them regionally. I mean, actually, what you've seen regionally is certainly through the course of the pandemic and through the course of last year, is that with this big caveat, we don't have a lot of information. It appeared tighter outside the big cities. So that's not necessarily, a great swathe in one direction in the country or another, but certainly conditions in London in particular look less tight, for example, than those outside. And I'll stop there. But.
Yeah. No, but it'd be interesting. I need to move on to the next bit, but it'd be interesting to sort of look at that regional disparity in the types of jobs, and therefore the impact in the different.
I was just going to say, we looked at in quite a lot of detail at the industry numbers and asked the question, how many vacancies are there in Industry X and how many unemployed people are kind of ready to work in Industry X? And interestingly, that mismatch index had shown a sharp increase, but then it fell right back down again, suggesting that there wasn't much mismatch, at least in that dimension. Now, to the extent that industries are correlated with regions, that gives you a little bit of an insight into regions, but there's not a 100% read across to regions, so that's true.
Great. And I want to talk a bit about the cost of living, and I was quite interested. I'm going to give you a really easy question, Governor. I'm hoping you're going to say nice things to. When you were talking to my friend Angela, you said, I think I was right in saying, I've written down, you said that companies should think about sort of their profit margin and think about their costs. So as a nice opener, I wonder if you will share my congratulations with Jack Monroe, the food poverty campaigner, who managed to get Asda not only to think about their costs, but actually reduce many of their costs for their basic goods, which had been increased so dramatically. So there's a nice question for you, Governor.
Well, and that shows that the market is working, but it had to be brought to the public attention, which I would just say is why I think these things have to be said, because it's a matter of bringing them to attention.
Equally so. And so now they've been brought to the attention, you're pleased that the supermarkets have acted in that way. Would you like to see similar supermarkets acting in a way of restraining some of their profits?
It's not for us to sort of, in a sense, dictate to people what they do. I do think the fact that there is, evidence of a market working in that sense, admittedly, once the issue was brought in the parliament, is helpful in that sense. It's a pricing mechanism working in that sense.
Could I come in a second and forgive me? Forgive me. I wear another hat because I'm on the board of the UK Statistics Authority, and this raises, I think, an issue about how we measure inflation. And Jack Monroe has rightly, and hats off, to them for bringing this to people's attention. Whether the inflation measure, of which we are we're targeting, average inflation, is sort of salient to lots of individuals. Yes. And people from the ONS have met with Jack Monroe, as you'll know, and before the pandemic, I'll say we, with my ONS hat on, we used to publish different inflation indices for people at different, pensioners and different people in the income distribution. That was suspended over the course of the pandemic because the ONS had a couple of other things to do, like running the infection survey and all that kind of thing. That's going to be restored. And the ONS is working hard and has a whole programme, as I say, and has met with Jack Monroe to examine the extent to which, as I say, these price indices can be sort of split out in various different ways. And I'll say one thing. I'll say one more thing, if I may, because it gets me very excited. There are these difficult kind of conceptual issues about how you construct price indices in the circumstances that Jack Monroe describes. So when she describes that they go to a supermarket and can't find a basic good anymore and has to switch from a basic pasta to a more expensive pasta. We don't, in the price index world, treat that as a rise in prices, because we think that basic pasta and fancy pasta is a change, at least some change in quality. So what the person, when they're doing that switch, is doing is they're not, to them, what's salient to them is it's an increase in prices, but they're switching their consumption basket as opposed to the basic pasta raising the price of the basic pasta. So there's some kind of quite tricky conceptual issues about putting these inflation indices together. I think it's one of the reasons why there may be a mismatch between the kinds of inflation which perhaps your constituents sort of perceive and the kinds of inflation which are measured officially.
It's really interesting, because what I think her campaign highlighted was that for those relying on the more basic goods, they were seeing 70+% increase in their costs compared to those consumers who weren't relying on basic goods and would have always bought more expensive items. So if there's a different way to measure that and illustrate that, which doesn't mean, we have our one food poverty campaigner having to go out there on every national media channel and advertise it, that would be great to have that information and really make the point that she's made. I just want to ask now particularly about younger people and the cost of living. Do you think the cost of living increases have had a disproportionate impact on younger people, or do you see it more as older people who are going to be the worst affected because of, for example, the hike in gas prices?
You've got a bit more ONS evidence on it.
Yes, again, so the ONS have put out a release on this. They did two comparisons. The comparison was between, I think it was retirees and I can't quite remember. It was older and younger people. I can't.
Retired and non-retired.
Yeah, thank you, Silvana. Retired and non-retired. Also between high income and low income. And actually, from memory, that release showed roughly the same price inflation challenges facing both of those groups. The reason being is, for high-income, low-income people spend more on gas and sort of household goods and all of that. High-income people spend more on restaurant meals and hotels and all that kind of thing. Transport, yeah, thanks, yeah. Those prices have gone up, as well as the gas prices, as we were just discussing in a lot of detail, has gone up as well. So in fact, the rate of inflation for those two different groups is rather similar.
I'm just going to draw a quote from this Financial Times, did an article called Britain's Young Face a Poorer Future, and they've said, in this article it says, the government is freezing the income level at which graduates will be asked to start paying back their student loans. Inflation will therefore draw many not very well paid graduates into repayment, equivalent to an increase of income tax around 9% a year. A combination of such stealth taxes and the increase in national insurance mean that the Intergenerational Foundation, a think tank, estimates the disposable income of a typical 27-year-old graduate will fall by close to 30% over 4 years as a cost of living crisis looms. Is that something you recognise or you would agree with?
Well, obviously, we take announced government policy in, as it were. We don't second guess it. We also, where we can, use the OBR's conventions and interpretations of the impact of those policies, so that again we don't, wherever we can, we don't second guess that.
Okay, well, I'm going to ask you to do a bit of guessing, a bit of predicting.
Okay.
So if this is correct, and for some young people it'll be the first time in dealing with significant price rises, what do you think that will mean for how they react? Do you predict they will consume less, save more or less, work harder, bargain for wages, change jobs, or a mixture of all of these? And what would that mean for the economy?
Well, I suspect, going back to what I was saying earlier, that it will be a mixture, because it depends on their bargaining power, and for instance, in the labour market.
I'm going back to joining a trade union there, Governor, aren't you? But if
it's a real income shock for them, and so there will be, a wealth effect, which will drive them potentially to try to work more. So in that sense, you probably would expect them to participate more. On the other hand, obviously there's a substitution effect that we call in economics. It's less attractive to work because you're making less. But I think in this instance, because of the cost of living hit, the wealth effect is likely to dominate, and will then, mean that there will be I think, more eager to work, and in terms of that margin at least. In terms of consumption, it's a big hit to real income. So they would probably need to cut on consumption on other items in the basket. Again,
well, that's an aggregate. Obviously, that's an aggregate.
Yeah, but also for individual people who are hit by the shock.
Thank you. I realise I've gone over. So sorry, Chair. Thank you.
I'm going to come to Siobhan in a minute. Can I just go quickly back to employment? So we talked about unemployment, the employment levels, people dropping and becoming economically inactive. The government says, and I assume this is correct, that the level of payroll employment is higher now than it was pre the pandemic. So how do you square that with what's going on? And does that lead you into, I think, concluding that the level of self-employment has actually climbed quite markedly? My question to you would be what your observations of that are, and what you think has driven that. Has that been driven by a flight to greater certainty of working for somebody else under difficult times? Has some of it been to do with the way IR35?
I was going to say IR35 is a factor.
That group, and therefore more of them are just basically changing the way they operate.
Well, my understanding of IR35, which I, in no sense claim to be an expert, is that it does have that effect, because in some circumstances what it means, I think, is that somebody who was being treated as was self-employed previously actually can't be treated as self-employed. I mean, I think that's particularly when you're contracting over longer terms to the same employer. So I think it has contributed. Now, I honestly don't know what contribution it's made.
Also, remember that disproportionate part of that growth in overall employment has come from the public sector, where people are much more universally employees rather than self-employed. So necessarily that will have had some. And I think the private sector employment in aggregate, whether in payroll or self-employed, is still lower than it was before the pandemic.
No. Anybody else got any observations on the self-employed point? No? Okay, just interested. Thank you. I'm going to go to Siobhan, please.
Thank you very much. Governor, I get the impression this morning that you're feeling slightly sensitive about the reaction to your comments about pay restraint. I wonder if you can understand people's responses, in that we've often spoken at this committee about the different impacts that the pandemic has had on different groups of people. Wealthier people generally got wealthier, were able to work from home, make substantial savings, while frontline workers, particularly carers, of course couldn't do that, were putting themselves in harm's way, were doing their job, were not able to save, were experiencing very low pay, and in a market which clearly doesn't work because these people are very much in demand. They've also got essential skills that we may all, however mighty at some point in our lives, actually need. So do you think there might be a specific reason why we should see carers looked at for increased earnings? And I know we've spoken a lot about trade union membership this morning, which is quite unusual for the Treasury Select Committee. But the GMB is calling for a £15 an hour pay for people who are carers. Would you agree with that?
Well, can I put it into context? The reason I made the comments, and I have hopefully, importantly added something to it this morning, which I wanted to, because it was a particular question I was asked, is, as I said, is that I'm very concerned about the effect of the second round effects. And obviously the effects we could see for inflation, but then also, as I said, just come back to this point about the fact that those effects will not be evenly distributed, that there are groups in society will be much more severely affected. Now, I have to say, I don't think it's appropriate for me as Governor of the Bank of England to make an observation about the pay level of a particular group in society, but I'll take my hat off, governor's hat off. My mother was in a care home for several years. I had close experience with it. I have an enormous respect for people who work in care homes. It's a very, very difficult environment to work in.
Thank you.
I'll
Thank
put
you.
my governor hat back on again now.
Yeah,
But
well,
that's
yeah,
a,
yeah,
it's
thank
a private
you.
observation which
Yeah.
I will make to you.
But you can understand how
No, I
emotional
completely-
people feel, particularly about
I
this group of
completely
people.
understand the point.
Yeah.
But what I would say about the comment I made was that because it applies to the economy as a whole, is I know it's unpopular to say it, but there is a real risk here. And I think it is something that we just do have to have in mind. But that's an aggregate comment about second-round effects.
We understand your point, Governor. Our problem is something that my mum, who was a nurse, she always had a political phrase, and that was, much gets more. So today, we've heard on the radio and in the newspapers that bankers' bonuses are back with a bang. Barclays, who couldn't afford to keep their branch open in Mitcham Town Centre, and HBC, who started charging business rates to voluntary groups, will be raising their bonus pots by a staggering 23% and 31% respectively. There seems to be a disconnect between those who are really struggling and those who are not struggling even before they get their bonuses. So would you like to make a statement about the impact on inflation of these sorts of bankers' bonuses?
Well, what I will say is that I think it does illustrate, unfortunately, the point I was making is that in a process where there is people essentially trying to sort of offset the shock to real income that we've had from outside, some will be better able to do it than others. I'm not making a particular point about bankers at that point. By the way, I should say, as the wearing another of my hats, the bonus cap is still in place, but that does obviously give scope within. I'm not saying that stops bonuses increasing, but it does cap them. But I think it does illustrate my point as a sort of broader matter that the impact of this will fall unequally, and it's not my role as Governor of the Bank of England to dictate the outcomes, but I am going to use my position to say we need to be very clear that those things can follow. There's limits to very, very big limits to what I can do about it, but I do want to point that out because that's one of the reasons I made the comments, and I know I'm pretty unpopular for it, but I really want to emphasise that point.
Do you see the need for even-handedness? That actually we've had a generalised statement about people's earnings and now we have substantial return to bankers' bonuses. Do you have something to say to the banking world about the bonuses?
It's not within... I'm not going to treat this as a particular banker's point. It's a point about the labour market as a whole. I can't... the Bank of England can't dictate the outcomes there. I did feel I had a responsibility from the point of view of the sort of the economics of this and the second round effects to point it out.
Okay.
Unpopular though it is.
There seems to be quite a few things going on in the banking world, closing branches, reducing services to customers. But one of the things that really shocked me recently was a number of voluntary groups who require membership and often provide a lifeline to people. And we are all hearing about more people with mental health problems worried about increasing prices and how they're going to meet them, and requiring many of these groups help. That HSBC are now deciding to extend all the sort of business charges to these groups. Do you agree that they should reconsider such a policy?
I think that's an issue, if you don't mind, wearing my former hat, that you should take up with the FCA. Because access to banking is an important issue and it's an FCA issue.
Okay, thank you. And as I said, we've had lots of discussions about how the pandemic has affected higher and lower income families. Given this, do you think that the gap between lower income households and higher income households has widened or closed during the pandemic? What impact has the Bank of England's decisions during the pandemic had on that gap?
I don't think I'm afraid to say I don't think I've seen particular data on that. I think what I would observe is, and I think we have said this in the past, that certainly in the early phases of the pandemic, the impact was probably larger on the less well paid, and the reason is that COVID had a bigger impact on those parts of the service sector that require close human contact, and we know, I think, that there is a larger concentration of low-paid workers in those sectors. So it did. Now, I haven't seen, to be honest with you, I don't know whether my colleagues are, I haven't seen any evidence coming out of COVID as to where that's got to.
We haven't yet had, I think, the survey data that tell us about income inequality. They come out with quite a delay. So we're not in a position to say them. And I will say that those things have been pretty flat, actually, both for income and for wealth over the last, broadly speaking, 20, 25 years. They really haven't done much. So the UK stands in some contrast to, say, the US and indeed some countries in Europe where those measures of inequality have been rising. But we don't yet know, beyond what Andrew said, about the likely effect of the pandemic because of the skew in the job losses to the very sectors you were talking about, those that require human contact. We haven't actually had the official data that tell us the consequences for income inequality.
If we look at housing, there seems to me to be a huge gap in the difference between poor and wealthy people, the ability to own your own home. And given the extraordinary increase in house prices, both during the pandemic and since, with the dream of home ownership being further away from even more people, in retrospect, do you think the government's introduction of the stamp duty holiday was a wise move, or did it just stoke property prices further?
Well, I'm not going to comment on government policy, if you don't mind. What I would say is that I think I'm right in saying the proportion of first-time buyers, this is an FPC point actually, the proportion of first-time buyers amongst total buyers has actually increased in recent years. However, certainly when we look, and we've recently reviewed the FPC.
It's not back to the 90s levels or the early 2000 levels.
I'd really have to come back to you on that. I don't know off the top of my head. When we do look at we've recently reviewed the FPC's housing tools, and that caused us to look at the housing market. And because we've all got in the FPC remit letter a point on first-time buyers, we did look at this. And I think, our strong conclusion is that the biggest thing limiting people coming into the housing market is affording the deposit. Yeah.
Thank you, Chair.
Thanks very much, Siobhan. Anthony, please.
Thank you, Chair. So I'm not going to ask you about monetary policy to start with. I'm going to ask about something more topical. Yesterday, the government imposed sanctions on 5 Russian banks. Do you think that will have any impact on London as a financial centre?
Well, I think look, these sanctions are very important. And I'm not going to comment on, I'm not going to comment on the sort of the tactics and strategy of diplomacy.
Yeah, I'm not asking you to comment on sanctions policy, it's just the sort of the impact of the sanctions.
What I do want to do is endorse what the Prime Minister has said, which is it is absolutely important these sanctions are applied, they're applied with rigour, but it's not for me to judge. There's a lot of talk about sort of scaling up sanctions. That's not for us to judge. That's for sort of the tactics of diplomacy.
No, I wouldn't expect you to
but they must
comment
be
on sanctions policy, but it's about the impact of
it's
sanctions.
clear they've got to be applied with rigour. That's the thing.
What's needed to apply them with rigour?
Everybody involved's got to get on with it, frankly, and do it rigorously.
Do you think there's a view out there amongst certain commentariat that actually London's so awash with Russian money that actually we risk self-harm by sanctioning Russian banks more severely? Do you think there's a risk to London as a financial centre if we, for example, stopped all Russian banks having access to clearing banks and therefore access to the Bank of England?
Well, I think it's for the government to lead on that, and I think they are leading on it. And I would strongly support the Bank of England. We have provided, where we've been asked technical advice on various things through the Ukrainian crisis. They have all, they can have as much of our advice and support as is needed because we're strong supporters. And the only thing I will say is I think this situation is so serious that I think we must, as the Prime Minister has said, we must put it first. I don't think that saying, well, this could be a bit damaging to London as a financial centre is just really an argument that just holds water.
No, I certainly personally fully agree with that. There's been speculation that America would push for Russia not to have access to the SWIFT system, the global payment system. What do you think the impact of that would be?
Well, in many ways, I would suspect quite substantial. What I can't tell you honestly is there is talk about the fact that there have been alternatives developed by other countries. I'm not in a position to judge how real those alternatives are because I don't think they've been used extensively yet.
Do you think that, come back to the point about banks having Russian banks, and there's a spare bank is listed on the London Stock Exchange, it's got a capitalisation of 43 billion, it's actually one of the biggest market capitalisation of UK banks in the UK. Stopping them having access to clearing banks and having access to the Bank of England as a result, what impact do you think that would have on their operations?
Well, it would have quite a substantial impact, I suspect. By the way, when you say access to the Bank of England, I mean they don't borrow from us.
No, they don't. They're not clearing banks, but if they do obviously operate through UK clearing banks.
They're in the market, yes. Yes, well, I mean, obviously, rigorously applied sanctions would have a substantial impact.
You want to come in on?
Yeah, possible. Yes, I mean, on a similar theme, I mean, you might have seen the debates in the chambers yesterday in terms of sanctions being applied, and I'm not asking you to comment at all on government policy. It really, as Anthony was saying, it's about what's a systemic risk if we did that. If we effectively cut Russia off completely from the City of London, other financial markets, what impact would there be on our banks? I mean, Sberbank, for example, we talked about, there's been no sanction on that yet, but it's a huge bank, and there's interdependency clearly with other banking sectors.
I can tell you, because obviously we do look at this from the point of view of both the PRC and the FPC, that the UK banking system's exposure to Russia is very low, actually.
Okay.
So we start from a position where those exposures are low.
So you don't see a systemic risk if we did that in terms of the UK financial
I don't
sector?
see a systemic risk to the UK banking system,
Okay.
no. I mean, we will obviously watch it, as you can imagine, and are watching it very carefully, and we're working very closely with the government on it, and will continue to do so.
Sure. What about, is it possible that we could cut Russian banks out from our off from our clearing banks? And again, would that mean any systemic issue for UK financial sector?
No, I don't think for the UK financial sector it's a systemic issue, no.
And do you think, could you comment on how damaging that might be for another country like Russia if we did that?
It's very hard for me to, well, I can't comment on that because I don't know enough about how the Russian financial system, A, works today, and B, would work tomorrow in the event of that happening. I just can't comment. But I just leave you with, I just want to comment, we are very strong supporters of what the government, we will give all the help that is needed to do what the government wants to do on this.
Good to hear, thank you.
I had did have some other questions on monetary policy actually.
Oh right.
The last section, which is just sticking with the global theme, but from a monetary point of view, that in your monetary policy committee reports, you've stressed the importance of global inflationary pressures, and in the UK, the debate, we tend to obviously focus on inflation in the UK, but actually it's just as high or higher in America and Germany and elsewhere. How serious is that impact of global inflationary pressures on the UK, and doesn't it mean that the interest rate changes you make here will have limited impact if it's all driven by global pressure? I was going to ask Andrew, but I don't know if Ben wants to comment, or indeed anyone else.
I mean, on this, to take the second point first, I don't think that's the case. I mean, there are many, many influences on inflation that are domestic that we can't directly do something about, but we still have, the ultimate influence on inflation over the medium term is monetary policy, regardless of what shocks there are in the short term or where they arise. The global point is very significant. In fact, we've been pointing it out for a lot longer than just February. It's been evident throughout the last year, and we've talked, for example, about the big switch in spending away from services to goods that occurred everywhere during the pandemic and has gone on and has persisted for much longer, certainly, than I expected when it first became apparent in this country, which was over a year ago. And we've been talking about the supply chain problems. And then this morning, separately, about energy. So these things have been going on for quite a long time. The vast bulk of the overshoot in inflation in this country relative to target is due to these factors. And when we began the session by talking about whether the shocks to inflation would be transitory or permanent, that's the biggest single component. My own view is that those contributions will be transitory, That's why we've been focused instead a lot over the last 6 months or so on the domestic stuff, on the risk of second-round effects that Andrew was talking about, on the tightness of the labour market. And so despite the fact that these contributions to inflation currently are very significant and overwhelmingly global, looking ahead 2-3 years, as we should, our focus has been more on the domestic costs and domestic cost inflation, and that's why the considerations that Jonathan was talking about sometime about the furlough scheme, the tightness of the labour market, and so forth, all the stuff we were thinking about in the summer, that's why that actually has been the more important thing for policy decisions. So I don't think we can do nothing about it, but it's because ultimately our judgment is that these impulses, enormous though they are at the moment on inflation from the global forces, will not endure, and because the domestic cost tends to be the more persistent source of inflation, that's why our focus has been on the domestic stock.
Isn't it still the case that while global inflation continues at such a high rate and is exported to the UK, that it's going to be difficult to get inflation in the UK under control?
That is true. And it's true that it's a huge source of risk to headline inflation. But think about, for example, the contribution of gas prices, which is enormous, as we've discussed. I mean, the biggest increase in energy prices in a year relative to household income ever, probably. But even if gas prices stay at a very high level, which is not, as we've discussed, what is the central expectation in markets. But even if that is the case, the direct contribution to inflation will come down. You have to imagine that they'll carry on increasing at whatever we've seen, fourfold increase all the time for that not to happen. So just a stabilization at a very high level would mean a very steep fall in their contribution to inflation. And even in our central forecast, where we assume that happens, that they stay at this very high level indefinitely, inflation does come down. Now, it remains above the target in a couple of years, but nothing like the current rates. So you're right, were it to carry on, were we to have another fourfold increase in the price of gas, yes, but certainly in the eyes of the marketplace, that's pretty unlikely, and indeed the market price is in falls in the level. And in other words, if you look at the scenario based on the full market profile of gas, inflation in 2-3 years is comfortably below target. So the outlook is hugely sensitive to these developments, but when you say if it carries on, I'm just saying that in wherever you see financial markets pricing future events, that's a long way from what's expected.
Given all that, what do you see as the main international risks to the UK then, or to the UK economy in terms of growth and inflation?
I mean, that is clearly the main source of risk at the moment, as global prices of energy and other globally traded goods. And beyond that, I wouldn't venture to say what the main risks. I mean, there are all sorts of geopolitical events.
Well, I was going to follow up with that as the last question, which is, clearly that with events in Russia and Ukraine, there's concern about gas prices spiking even further as a result.
Yes, I mean, it is, as I say, the way we do the forecast, and Ms. Ali asked us earlier about should we change the way, I don't think we should, means that the best approach we can take, I think, which is what we do, is to base our projections on prices in financial markets and forward energy markets and so forth, on the view that those represent pretty reasonable best stab at the future, still enormous uncertainty, but if you were to choose them, and then take our policy decisions accordingly. And so those global energy markets are also looking at developments in Ukraine, obviously, and trying to price as best they can the risk to future gas prices. And I don't think that we can do better than just to take those prices as given.
That could spill over to renewed inflation in the UK.
Well, we began the session talking about the sort of thing. I mean, as it happens, the spot price the price of buying gas right now isn't much different, despite all these developments, than we had in the February inflation report. But we will continue to base the forecasts on those things, however they develop.
That's all my questions. Thank you very much, Chair.
Actually, thank you very much. Well, that brings us to the end. Thank you all very much for coming to see us today. It's been helpful and informative and instructive, as it always is.